All right, Billy Myers, I told you I was going to do this video, and this is for you and for all the other accounting students out there who may be interested in this really minutia level of accounting software. It may be absolutely boring to you, but there's one thing for certain, and that is that it will increase your riz factor. Now, here's what happens. If I had to guess, there were just a lot of computing horsepower left over after World War II. And the powers that be started looking around for ways to use these mainframes. And someone said, let's see, they're really good at doing math. So why don't we put accounting onto computers? And that sounded like a great idea until people started questioning, right now, all the accounting was done manually. And if we wanted to do a journal entry, and the journal entry was a debit for $100 and a credit for $100, we could look at that and say, that's a balanced entry. The debits equal the credits. Everything's great. Go ahead and do it. If it was a multi-line entry, let's say 6 debits and 13 credit lines, you'd have a piece of paper that showed that the numbers balanced. The debits have to equal the credits. That is the first rule of accounting. So they said, all right, how do we put this into computer talk? And how do we train the computer to recognize a balanced entry? And they started saying, well, let's see. Let's start off with the accounting equation. Now, the accounting equation is the backbone to our financial reporting industry. And that is that all of your good things, your assets, have to equal your debts. And what's ever left over is your ownership, your equity. ALE, my favorite type of beer. Assets must equal liabilities plus my equity. So they said, all right, how are we going to get the computer to understand that? And they said, well, let's see now. Assets are supposed to have a debit balance. Liabilities are supposed to have a credit balance, and equity is supposed to have a credit balance. So let's see, how can we do this? And they started, someone made a mandate, just a blanket mandate that said, if it's a debit, it's a positive number. If it's a credit, it's a negative number. So they said, all right, well, let's try this. So they put in a positive number for assets. And let's say it was an asset for $650,000. And that asset had a debt on it. The total amount of debts was $250,000, which means your leftover amount of money, your equity is $400,000. Very simple mathematics. So they said, all right, let's say if debits will have a positive number, credits will have a negative number. And that way, the mathematical result of every single financial transaction is 0. And a special thank you for Edwin Pete Wolf, my teacher at the Barrett College of Business at the University of Houston, for teaching me that 50 years ago. So let's go back. I go to make a debit entry. That would be an asset. That would be a positive sign. I put in my liabilities, my $250,000 worth of liabilities, and I put a negative sign in there. Then I put in my equities with credit entry, and that in the computer talk, that takes a negative. And look what happens. My positives, $650,000, equals my $250,000 liability plus my $400,000 of equity. This is how this whole process of recording financial transactions migrated from handwritten into the computer world. Well, what we had to do next was take the accounting equation and expand it to include my revenues and my expenses, because equity, which has a negative balance inside the computer, credit balance equals negative balance, is increased by my revenues. Well, if a negative number is increased by a number, that number must be negative to begin with. And then what is an expense? An expense is a contra revenue. So if my revenues have a negative sign, then my expenses, which have a debit balance, has to be a plus sign. They're so simple. So my equity is increased by the difference by my revenues and my expenses. And it worked out. It worked great, marvelous. Everyone signed off on it. And then they produced an income statement. The income statement shows my revenues and my expenses. And when they did that, they said, okay, here are my revenues, and they have a negative sign in front of my revenues because they have a credit balance. Then here are my expenses with an applied positive sign, a debit, an applied positive. And then what's left over? Well, my revenues were greater than my expenses, so I had a profit. So if my revenues are greater than my expenses, then my net profit has an applied balance of a credit, except the credit showed up as a negative number. Holy moly! Try to explain that to management. So they looked at that. Management wouldn't sign off on that. And also the liabilities would show up in the balance sheet as a negative number. The equity would show up as a negative number. Everything was fishmeckled. So the people are looking around for a liability. And then somebody remembers their 6th grade mathematics from Mr. Greenhill says, remember, any number multiplied by its a positive self equals that number. So 100 times a positive 1 will equal 100. 100 times a negative 1 will equal a negative 100. Basics. And here's where it got really, really good. A negative 100 multiplied by a negative 1 equals a positive 100. Basic math. So what do? Behind the scenes in the print program, before the reports get printed, they take the revenue amounts and multiply it by a negative 1, take the expense amounts, multiply it by a negative 1. Now, a negative number becomes positive, and then a positive number becomes a negative, and my profit shows as a positive number, totally eliminating all this confusion caused by the original program. And like I said, this is pure minutia, but you may enjoy this. And I know that Shannon Brady and all her colleagues in Stamford, Connecticut at Friday's Happy Hour will be discussing this as something very, very interesting. Tune in for the next video.